Everyone talks about stocks, some flex crypto, a few pretend to understand venture capital. But what's the real power in global finance? It's sitting quietly behind closed doors, literally buying companies, fixing them, and selling them for billions. Welcome to the world of private equity, the asset class that shapes the economy, but you'll never hear about it on X or Instagram. So let's break it down here. You know what's common between Burger King, Tim Hortons, and Heinz? It's the one PE firm, 3G Capital, quietly owning each and every one of them. Private equity is the asset class that lives in the shadows of public markets, but increasingly shapes the engine of global capital allocation, industrial transformation, and strategic corporate control. It is not venture backed up by hype, it is private ownership, heavy balance sheet mechanics, and operational rewiring, and long-term cycles. At its core, private equity refers to the equity capital invested in companies that are not listed in the public stock exchanges, or where public companies are taken private and restructured under PE ownership. A PE fund raises capital from institutional investors, pension funds, endowments, sovereign wealth funds, high net worth investors, and then fund managers deploy that capital to acquire controlling stakes in businesses, operate them, improve performance, or restructure and exit after a holding period of 4 to 7 years. This industry is huge. Global private equity AUM crossed $4.7 trillion and is on the track to be a hit of $5.8 trillion by 2025. That's bigger than GDPs of most countries. Even with rising interest rates and inflation, institutions kept pouring money in because PE offers something public markets don't: control, patience, and high return potential. McKinsey's report in 2025 even showed that PE funds returned more money to investors than they raised for the first time since 2015. How private equity actually works? A simple version: think of private equity like buying a house that needs fixing, renovating it, and selling it 5 years later for a bigger profit. Except instead of houses, they buy the entire company. Let's talk about a few points. The first being leverage. Buying companies with borrowed money. PE firms rarely buy companies with only their money. They use a mix of some of their money and a lot of borrowed money. This is called leveraged buyout. It's like buying a 1 crore house by paying 30 lakhs upfront and taking a 70 lakh loan. If the house price increases, you return the 30 lakhs, becoming huge. Same idea, but with companies. The second point being operational makeover. Fixing what is broken. Unlike passive investors, PE firms actively intervene. They streamline operations, cut inefficiencies, refashion management, reorganize cost structures, and optimize working capital, and sometimes reimagining the entire business model. This often unlocks value that public market investors undervalue due to short-term horizon bias. The third point being selling for a profit. PE exits typically happen after 4 to 7 years, either through an IPO or a sale to a strategic acquirer, a secondary sale to another PE firm, or in some case, dividend recaps. The ability to exit at a premium relative to an entry valuation after value creation is essential to return realization. Because liquidity is limited and exits are few and far away, PE demands a long-term commitment. Investors trade off liquidity for a potential outsized return and control. The goal is simple: buy, fix, and sell. Make outsized returns because these deals are long-term and illiquid. Investors wait years for a payout, but the returns can be much higher than public markets. Common private equity strategies. Leveraged buyouts, buying a solid, mature companies using a lot of borrowed money, fixing them and selling them for more. Growth equity investing in companies that are already doing well, just need fuel to scale. Venture to early growth, backing younger companies with huge potential but higher risk. Distressed or turnaround, buying companies that are struggling, fixing them and bringing them back to life. Each strategy balances risk to reward differently. LBOs turn to use leverage and focus on cash flows. Growth equity and venture invest in scaling but riskier businesses. Distressed investing involves high operational risk but potentially high returns in restructured successfully. Now let's discuss what changed in private equity from 2024 to 2025. The big private equity reset. The world of private equity went through a major reality check. Higher interest rates, expensive loans, and tighter capital suddenly made debt-heavy deals much harder. Because of this, traditional private equity fundraising dropped by 24% in 2024. The third year in a row, it slipped. But private equity didn't die, it evolved. Investors simply shifted their money into newer structures like evergreen funds, continuational funds, GP stakes, basically models that did not depend on so much old school debt tricks. At the same time, a huge big shift happened inside private equity firms. Operational improvement became more important than financial engineering. Instead of buy, add debt, sell higher, firms started focusing on fixing businesses and making them stronger. And for the first time since 2015, investors finally started getting real cash returns again as older funds matured. Put together, this marks a turning point for private equity in moving away from debt-powered era into a built on real operations, resilience, and smart long-term investing. So what's coming next for private equity? Why is the next decade a big deal? As interest rates calm down and inflation stops being chaotic, investors will start pouring money back into long-term operations, the kind that need time and not hype. Private equity is becoming a core part of global investing. Private markets are expected to keep growing fast. Big institutions, pension funds, sovereign funds, and endowments now treat private equity as a must-have, not a side bet. The next wins will come from operations and not fancy finance. Technology, automation, ESG, and better management. These will matter more than loading companies with debt. Private equity firms that can actually improve businesses will win big. Growth will shift towards emerging regions like Asia, Latin America, and parts of Africa will attract huge investments, especially in manufacturing, infrastructure, and consumer markets. Asia is already showing a private equity comeback with some serious deal activity. New fund structures will change how private equity works. Evergreen funds, continuational funds, GP stake funds, hybrid instruments. Private equity will be more flexible and accessible than the old school method, 10-year locked-in fund model. The bigger picture, the next decade of private equity won't be quick flips or debt-heavy buyouts. It'll be about patient capital building real businesses, slow, steady, and structural growth. Private equity isn't a gamble or a hype machine. It's becoming the quiet engine that rewires industries, rebuilds companies, and shapes how global capital flows. And the biggest wins, they won't come from stock tickers. They'll come from the invincible work that is done inside balance sheets, where the real value is created long before the world sees it.